If you are a business owner and you regularly work at home, you may be able to claim the home office deduction. Even if you have an outside office where you do the most of your work, you still may be able to use this deduction. There are strict requirements you must follow, and how you claim the deduction will depend in part on what type of business entity you have. In this presentation, we'll discuss the qualification for home office deduction. Qualifying for the home office deduction. You must have a home office, that is, an office or other workplace in your home that you use regularly and exclusively for business. Your home may be a house, an apartment, a mobile home, or even a boat. You can also take the deduction for separate structures on your property that you use for business, such as an unattached garage, studio, barn, or greenhouse. There are 3 threshold requirements that everyone must meet to qualify for the home office deduction. You must be in business. Use your home office exclusively for business unless you store inventory in your home, and use your home office for your business on a regular basis. You must be in business. You may take the home office deduction only for a business. You cannot take the deduction for a hobby or another non-business activity that you conduct out of your home. You don't have to work full-time in a business to qualify for the home office deduction. If you satisfy the requirements, you can take the deduction for a side business that you run from a home office. The side business can even be related to your regular business. For example, a surgeon who established a biopsy lab in his home was able to claim the home office deduction for the lab because the lab was a separate business from his surgical practice. However, you must use your home office regularly, and the total amount you deduct cannot exceed your profit from the business. Exclusive business use. You must use your home office only for your business. This requirement does not apply if you store inventory at home. If you use part of your home, such as a room or garage, as your business office, but you also use the same space for personal purposes, you will not qualify for the home office deduction. Regular business use. Unfortunately, the IRS does not offer a clear definition of regular use. The agency has stated only that you must use a portion of your home for a business on a continuing basis, not just for occasional or incidental business. One court has held that 12 hours of use a week is sufficient. It's a good idea to keep track of how much you use for your home office. If you get past this first hurdle, then you must also meet any one of the following 5 requirements. You use your home office as your principal place of business. You regularly and exclusively use your home office for administrative or management activities for your practice and have no other fixed location where you perform such activities. You meet patients, clients, or customers at home. You use a separate structure on your property exclusively for business purposes. You store inventory or product samples at home. These rules apply whether you are a sole proprietor, partner in a partnership, or an LLP, a LLC owner, or if you have formed a C or an S corporation. However, if you're an employee of a corporation that you own and operate, or have formed a multi-member LLC, LLP, or partnership, there are some additional requirements which I will discuss later in the presentation. Let's go through an example to understand the flow of the requirements for home office deductions. Is part of your home used in connection with a trade or business? Yes. Are you an employee? Yes. Do you work at home for the convenience of your employer? Yes. Do you rent part of your home used for business to your employer? No. Is the use regular and exclusive? Yes. Is it your principal place of business? No. Do you meet patients, clients, or customers in your home? No. Is it a separate structure? Yes. Congratulations, deduction allowed. Special requirement for employees. If you have formed a corporation to own and operate your practice, you're probably working as its employee. Prior to 2018, employees could claim a home office deduction if they satisfy the requirements discussed previously and maintain the home office for the convenience of the employer. In this event, they could claim the home office deduction as a personal miscellaneous itemized deduction on Schedule A. However, during 2018 through 2025, this deduction is no longer available for employees. So, if you work as an employee of your own corporation or a corporation owned by someone else, you should seek to have your home office expenses reimbursed by your employer. The corporation can then deduct this amount as an ordinary business expense for the office space. To avoid paying tax on your reimbursement, all of the following must be true. You satisfy all the requirements for the home office deduction. You maintain the home office for the convenience of your employer. You have an accountable reimbursement plan, which is a written agreement in which the corporation agrees to reimburse you if you provide proper substantiation for your expenses. A good way to accomplish the reimbursement is to complete IRS Form 8829, Expenses for Business Use of Your Home, and attach it to your expense report. Calculating the home office deduction. You have the option of using a simplified method of calculating your deduction or the actual expense method. To calculate your home office deduction, you need to determine what percentage of your home you use for business. The law says you can use any reasonable method to do this. Try either square footage method or room method and use the one that gives you the larger deduction. Square footage method. The most precise method of measuring your office space is to divide the square footage of your home office by the total square footage of your home. You are allowed to subtract the square footage of common areas such as hallways, entries, stairs, and landings from the total area that you're measuring. You can also exclude attics and garages from your total space if you don't use them for business purposes. Room method. You can use this method only if all of the rooms in your home are about the same size. Using this method, you divide the number of rooms used for business by the total number of rooms in the home. Don't include bathrooms, closets, or other storage areas. You may also leave out garages and attics if you don't use them for business. Note, even though IRS Form 8829, Expenses for Business Use of Your Home, which is the form sole proprietors file to claim the home office deduction, seems to require you to use the square footage method, but this isn't the case. As long as all of the rooms in your home are about the same size, you can use the room method. Using the room method will often result in a larger deduction. What expenses can you deduct? Most costs associated with maintaining and running your home office are deductible. However, because your office is in your home, some of the money you spend also benefits you personally. The IRS deals with this issue by dividing home office expenses into two categories: direct expenses, which benefit only your home office, and indirect expenses, which benefit both your office and the rest of your home. Direct expenses. You have a direct home office expense when you pay for something just for the home office portion of your home. The entire amount of a direct home office expense is deductible. Important note, if you add a new room to your home to serve as your office, you may have to depreciate permanent improvements to your home over 27.5 years rather than deduct them in the year when you pay for them. Indirect expenses. An indirect expense is a payment for something that benefits your entire home, including both the home office portion and your personal space. You may deduct only a portion of this expense, the home office percentage of the total. Most of your home office expenses will be indirect expenses, including rent, mortgage interest and property taxes, depreciation, utilities, insurance, home maintenance, casualty losses, security system costs, and condominium association fees. Profit limit on deductions. You cannot deduct more than the net profit you earn from your home office. If you run a successful business out of your home office, this won't pose a problem. But if your business earns very little or loses money, the limitation could prevent you from deducting part or even all of your home office expenses in the current year. If your deductions exceed your profits, you can deduct the excess in the following year and in each succeeding year until you deduct the entire amount. You can claim them even if you no longer live in the home where they were incurred. So whether or not your business is making money, you should keep track of your home office expenses and claim the deduction on your tax return. The profit limitation applies only to the home office deduction. It does not apply to business expenses that you can deduct under other provisions of the tax code. Until recently, homeowners who took the home office deduction were subject to a special tax trap. If they took a home office deduction for more than 3 of the 5 years before they sold their house, they had to pay capital gains taxes on the profit from the home office portion of their home. For example, if you made a $50,000 profit on the sale of your house and your home office took up 20% of the space, you would have had to pay a tax on $10,000 of your profit. That is 20% times $50,000 equals $10,000. Fortunately, IRS rules no longer require this. As long as you live in your home for at least 2 out of the 5 years before you sell it, the profit you make on the sale, up to $250,000 for single taxpayers and $500,000 for married taxpayers filing jointly, is not taxable. However, you will have to pay a capital gains tax on the depreciation deductions you took after May 6, 1997 for your home office. These recaptured deductions are taxed at a 25% rate unless your income tax bracket is lower than 25%. Having to pay a 25% tax on the depreciation deductions you took in the years before you sold your house is actually not a bad deal. This is probably no more and is often less tax than you would have had to pay if you did not take the deductions in the first place and instead paid tax on your additional taxable income at ordinary income tax rates. Simplified home office deduction method. In a rare move to simplify life for taxpayers, the IRS has created a new simplified optional home office deduction calculation method. You still have to use a portion of your home regularly and exclusively for business. The simple method really is simple. You deduct $5 for every square foot of your home office. All you need to do is measure the square footage of your home office. For example, if your home office is 200 square feet, you will get a $1,000 home office deduction. That's all there's to it. Another big plus, you don't have to complete Form 8829. Homeowners using the new option cannot claim depreciation deductions for their home offices. However, they can claim allowable mortgage interest, real estate taxes, and deductible casualty losses on the home as itemized deductions on Schedule A. These deductions need not be allocated between personal and business use as is required under the regular method. Business expenses unrelated to the home, such as advertising, supplies, and wages paid to employees, are still fully deductible. When you use the simplified method, your home office deduction is capped at $1,500 per year. You'll reach the cap if your home office is 300 square feet. So if your home office is 400 square feet, you'll still be limited to a $1,500 home office deduction if you use the simplified method. You cannot carry over any part of the deduction to future years. Let's do comparison of regular and simplified home office deduction methods. Simplified method versus regular method. Under simplified method, deduction for home office use of a portion of a residence allowed only if that portion is exclusively used on a regular basis for business purposes. Same under regular method. Allowable square footage of home use for business not to exceed 300 square feet versus percentage of home used for business. Standard $5 per square foot used to determine home business deduction versus actual expenses determined and records maintained. Under simplified method, home-related itemized deductions claimed in full on Schedule A versus home-related itemized deductions apportioned between Schedule A and Business Schedule, Schedule C, or Schedule F under regular method. No depreciation deduction versus depreciation deduction for portion of home used for business. No recapture of depreciation upon sale of home versus recapture of depreciation on gain upon sale of home. Under simplified method, deduction cannot exceed gross income from business use of home less business expenses versus same under regular method. Amount in excess of gross income limitation may not be carried over versus amount in excess of gross income limitation may be carried over. Loss carryover from use of regular method in prior year may not be claimed versus loss carryover from use of regular method in prior year may be claimed if gross income test is met in current year. How to deduct home office expenses. This depends on how you have legally organized your practice. For sole proprietors, you deduct your business operating expenses by listing them on IRS Schedule C, Profit or Loss from Business. You also list your home office deduction on Schedule C. But unlike any other operating expense deduction, you must file a special tax form to show how you calculated the home office deduction. This form, Form 8829, Expenses for Business Use of Your Home, tells the IRS that you're taking the deduction and shows how you calculated it. You should file this form even if you cannot currently deduct your home office expenses because your business has no profits. By filing, you can apply the deduction to a future year in which you earn a profit. For LLCs, LLPs, and partnerships, if your practice is organized as a multi-member LLC, LLP, or partnership and receives partnership tax treatment, you can claim a home office deduction in either of the following ways. You can deduct your home office expenses on your personal tax return on Part 2 of IRS Schedule E, or the LLC, LLP, or partnership can reimburse you for your expenses and list them on its tax return, and the deduction is then passed through to and shared by all the business owners. If reimbursement is not made under an accountable plan, the money that LLC member or partner receives is treated as a distribution from the LLC, LLP, or partnership and is subject to both income and self-employment taxes.